Hello, everyone. My name is Andrew Castleberry. Today, what we're going to be talking about is when to use a donor advised fund. Also, you'll commonly hear them called like DAFs or DAFs by cool people in the industry, aka myself. No, but when to use a donor advised fund. First off, I want to kind of explain what a donor advised fund is because it might be something if you're not necessarily familiar with it. It's not a commonly used term, it's not one of your common retirement accounts like an IRA or a Roth IRA or a brokerage account. So a donor advised fund is a specific account type you can contribute to essentially lump sum or put in charitable gifts that you don't necessarily want to give to charity yet. So let me explain. So you might have a large sum of money or an asset, and you say, hey, I know I want to give charitably. It's something that's one of my goals. It's something I've always wanted to do, or I do regularly right now. But I don't necessarily want to say give this large lump sum to a charity yet, or I don't really know where I want to give it, but I do want to go ahead and get the tax credit for a large charitable gift. You can give into a donor advised fund and allow that gift to be invested and grow, but not necessarily go to a charity yet. You can kind of wait and mull it over for an extended period of time, years, decades, whatever, and then gift out of that donor advised fund. So it is an avenue for you to gift without having to gift directly to a charity, but still be able to take the tax deduction or tax advantage of gifting an asset or a lump sum. So, what a donor advised fund is just an account that you would gift to, and that then has to go to a gift. So, once the money is in a donor advised fund, you can't take it back out. It is a gift. It has already been given. It has to go to a charitable organization, a 503c organization, out of the donor advised fund. So it's not like you can give to a donor advised fund, say 100,000 one year, 5 years later decide, oh, I really don't want to be that charitable, and then take it back out. That's not how it works. Once you gift it, it's in there. It's going to be designated as a gift at that point. So the time that 100,000 enters the account is when that gift is credited to you from like a tax return standpoint. And then it's just in there, and then you can give it to a charity at any point in time after that, but you can't take it back out and you can't give it to a non-charity entity. It has to go as a gift at that point. So that's kind of what the account is, and really a kind of really short overview of how you would use the account. We'll talk about some specific examples here in a second, but really why you would use it would be if you are already someone that's charitably kind of, or you're already charitable, like you already give on a regular basis, but you either want to give a little bit more, you want to avoid paying taxes in the future, or you want to avoid kind of having a higher required minimum distribution, whatever it might be. But there's just a reason that you want to maybe give an accelerated gift, but not necessarily pump it directly to a charity. Like maybe you give to a local church or a local food bank, or you give to some organization, but you want to give a huge amount of money to them, but you don't necessarily know if it'll be the best managed at one time or if it'll be something that'll become more of a burden. Then you might say, hey, let me set this up in a donor advised fund, give it to you over 5 years. I get the credit of a one-time massive gift to maybe pair against something else, but then you get income stream for 5 years at that point. So you can do it that way, but you would use it as a way to tax effectively manage your charitable gifting if you are already charitably minded. Like if you are not someone that is really going to give to charity or someone that gives to charity on a regular basis, a donor advised fund's probably not going to be something that you use all that often or maybe ever at all. So now, where do you open a donor advised fund? I mean, like Fidelity has donor advised funds, Schwab has donor advised funds. They're small, kind of more independent donor advised fund options, but a lot of people that like we work with and use like the Fidelity or the Charles Schwab ones because they either already have brokerage accounts there or retirement accounts there, and it's just ease of use. You can easily pass assets back and forth. It's just a simplicity thing, especially with a larger organization. There's usually a little bit more staffing behind the donor advised fund as well. But there are smaller companies that deal only in donor advised funds. Like that's all they do is the administration for them at that point. But again, you can open them in a lot of different places, the big ones being probably Fidelity and Schwab. And then the other thing is, can you invest in it? Like once you give into it, can you invest it? And then what can you give into it? So with a donor advised fund, you can invest in the account. So if you wanted to give cash, you could put the cash in, invest that cash, let it grow over time. So it's kind of cool because you could give technically like $100,000 of cash into the account, get the benefit of the tax deduction from giving to charity, but then invest that, and in 5 years, if it's 125,000, well, you get to give 125,000, still getting the benefit of that one-time gift, which is really, really nice. You don't get the benefit, like you don't get to take the growth is a kind of deduction, so you can't give 100,000, and then when you ultimately give, say, 125 out of that 100, you don't get to retroactively say, oh, well, I want to take credit for that 125 or the $25,000 difference, but you do get whatever you put in, and the growth is a nice extra of that charity ends up getting more money because you were wise and invested that asset rather than just giving it all in cash and then only getting 100,000. So that's another thing too. Like, so one of the examples would be if you were to give 100,000 and you were to give it all at once, or you were to keep it in cash yourself and give it over 5 years, the charity is getting either 100,000 lump sum or say $20,000 a year over 5 years. Whereas if you were to put that in a donor advised fund and invest it, and even in something that's like a moderately conservative or like a small investment growth, if it were to say grow to like 140,000 or 150,000 or even like 110,000, they're still getting that $100,000, but they're getting a little bit extra because that money grew over time. So you're able to help them out even more with still getting the tax benefits to you. The other thing that's nice is you don't have to give just cash to it. You can give appreciated stock. You can give physical assets, business interests. You can give art. You can give real estate. So one of the nice things too is you might be wanting to gift to a charity that is not able to process a physical asset gift. Like they can't process art or they can't process physical real estate, but there might be a donor advised fund out there that can do that and can help with the valuation and can help with the administrative burden of taking on a physical asset. So then you were able to give out of the donor advised fund to that charity in, say, maybe a cash or more liquid form that is feasible because the donor advised fund was able to work as an intermediary to that gift. So you were able to get the deduction in value of the hard asset, but be able to give to an entity that might not have been able to take that hard asset, so that physical thing, just because they didn't have the manpower or the ability or the know-how or the wherewithal. So I always think if you're giving to like a church or like a small local church, they just might not have any idea how to even handle a gift like that. Whereas a donor advised fund, that especially one that might have a specialty in something like that, would know very well, hey, how do we take this? What's the liquid market? How do we value it? And how do we eventually get that money to the end charity in the most efficient way? So that's kind of the ins and outs of a high-end overview of donor advised funds. And I'm specifically not talking about exactly the tax deductions because it does vary depending on what you gift in, what your income is. It's something I would highly recommend work with a very individualized year-to-year basis with your CPA and your planner to kind of coordinate what that looks like and how it works best for you. But I want to use kind of go over and wrap this video up with some examples of why would you use a donor advised fund? What are some situations where you might use a donor advised fund? I know we've hit on kind of some high level stuff, but some more specifics. So one example, and this is one we actually ran into really, really recently with a client, was they're really charitably minded. They like to give, they want to give, but they're getting close to required minimum distribution age, and they also want to do some Roth conversions. So one of the goals we were kind of looking at is, all right, how do we minimize required minimum distributions in the future? If you don't know required minimum distributions, we've talked about it in prior videos, but it's essentially when you have an IRA, you hit 73 for this scenario, you have to start taking a certain minimum amount out and you have to pay taxes on it. So in this scenario, it was a pretty sizable required minimum distribution, but we have a few years prior. So what if we looked at doing some conversions to try and lower that IRA balance, but we also want to mitigate the taxation? So what we looked at would be pairing a contribution into a donor advised fund in a single year with a larger Roth conversion to try and mitigate taxes, accelerate charitable giving, and kind of come out with a more favorable long-term result to lower potential taxes paid over the course of the entire lifetime. So what we did was we looked at essentially the next 10 years worth of charitable gifts that this client was going to originally do. And what we looked at was, what if we did those 10 years of gifts, but we accelerated it and gifted all 10 years of planned gifts into a donor advised fund all in 1 year. So rather than gifting maybe $10,000 over every year over a 10-year period, we just lumped that in and did it all in 1 year. And then rather than doing a smaller Roth conversion, we did a much larger Roth conversion to match that donor advised fund gift. So what effectively happens is we can do a big one-time gift. We can take that as a massive deduction. We can then do a large Roth conversion. At the same time, we take a lot of money out of his traditional IRA, which then lowers the required minimum distributions for the remainder of his working life. We also give a large amount to charity that we can write off at once, allows that to grow and be able to do charitable gifts over the next 10 years. And what it does is it makes the net tax consequence about the same as if he had just done a smaller Roth conversion, gotten less money out of the IRA, and still had higher RMDs. So what you're able to do is kind of plan a strategy around that. So if you are charitably minded, really look at it and say, all right, well, what if I match that with another retirement planning strategy? Like, you don't have to just do Roth conversions. You don't have to just add to a donor advised fund. You can do those things at the same time, pair them up really well, kind of like you'd pair a wine to a meal. It's something that goes together really, really well and creates a ultimate better outlook for you through the course of retirement without necessarily making a large negative impact on your taxes current year. So that's one example. And again, I started with probably the most complex example, so I apologize. Next example would just be to lump sum gifts. This one was really popular when the Tax Cuts and Jobs Act came in 2017 because the standard deduction got raised really high. So what happened for a lot of people was it pushed it to where they couldn't itemize. They were used to itemizing, but they couldn't itemize because the standard deduction was so high. So it negated any sort of regular charitable giving, because if it didn't get above that itemized or that standard deduction number, it didn't matter. So what some people did was, rather than giving on a monthly basis, they saved for 2 or 3 years, then did one lump sum into a donor advised fund, or they just accelerated it and did what they would have gifted into a donor advised fund, got 1 year of a massive deduction at that point, so really lowered their taxes, and then just used the standard deduction every single other year. And then once the money was in the donor advised fund, they gifted out of that. So you see something like that, or you just see someone that might just be undecided, but they received maybe like a large inheritance or a large sum of money, and they want to gift charitably out of that, and they want to go ahead and do it in 1 year, but they don't know where they want to gift. So one of the reasons you might use just a lump sum into a donor advised fund is you really just don't know where you want to give. You know you want to give, you know you want to be charitable, but you don't necessarily know the end location of that gift. Use a donor advised fund. That way you can take advantage of it. The money can grow while it's sitting in the donor advised fund and while you're thinking about giving and where you want to give, and then you can give out of it. The next would be simplifying giving. So this would be someone who is trying to actively give to multiple charities all at once, is trying to manage it around other planning strategies, might have physical assets they're trying to give, and they're trying to do all of these things, coordinate with different charities of who can take what asset's going to be best used over here. If you don't want to have to navigate that with a lot of different charities, but you just want, hey, I want one place I can do all of my gifting so I can keep track of it, make sure I'm reporting all of it correctly, and then I can gift out of that. Just simplifying your gifting if you are in a situation where you are giving to just numerous places all at once, doing it all to one place for tracking purposes, and then gifting out of that donor advised fund can add some simplicity if that is something that you are dealing with. And then finally, we've talked about it before, but gifting a hard to gift asset. A lot of smaller charities might not know what to do with a piece of art, might not know what to do with a car, might not know what to do if they inherited an IRA or something like that. But allowing that donor advised fund and that administration to help in the kind of allocation of those gifts, liquefying those gifts, being able to kind of push those to where you want it to go and handle those with a team that knows how to do it and has done it before is extremely beneficial. So ultimately, when it comes to a donor advised fund, to kind of wrap this up, it can be used for a lot of different ways, but it is something that I don't think a lot of people are as well versed in, and I don't think it's something that people think of right off the bat, but it can be a great way to make your retirement plan a little bit more tax efficient. Maybe milk the most out of your charitable gifts too, rather than just sitting in cash and waiting, but allowing something to grow and really already be earmarked for gifting. And then lastly, it's just a great way to kind of get your family involved too. If you leave that donor advised fund, like make the beneficiary of that donor advised fund a child, then they get to use those funds to gift to something they care about as well. So it can get your family involved in gifting as well. But I mean, great planning tool, great thing to do if it is something you want to plan on giving charitably. So that's about it. But again, check out the rest of our videos, subscribe to our channel, and hope this was helpful. Thank you. Bye.